Strategy Management Series. Video number 104 Strategy Formulation. Step 7 Strategy Evaluation. Evaluating the financial viability of a strategy. Welcome back to the Ready MBA series on strategy management. In our previous sessions, we delved into strategy evaluation, the crucial seventh step of the strategy formulation process. This stage entails scrutinizing potential strategies for their impact, benefits, costs, and resource requirements. We introduced the strategy choice cascade framework, based on the book Playing to Win, to help the planning team create effective strategies. In this video, we will focus on the fourth step, where the planning team must evaluate the economic feasibility of the strategy being proposed. They must translate all of the previous estimates of demand forecasts, pricing strategy, required resources, capabilities, and investments into a financial analysis that evaluates the strategy's viability, potential risks and return on investment. The financial analysis is a critical checkpoint in the strategy formulation process. While financial projections are based on assumptions, the analysis may reveal that the strategy, in its current form, doesn't deliver the desired financial results. This is an opportunity for the planning team to iterate and refine the strategy. By revisiting the where to play, target markets, and how to win competitive advantages, the team can adjust assumptions and potentially identify more lucrative market segments or refine the value proposition to enhance its appeal. This iterative process is crucial because it translates conceptual ideas into concrete financial implications. By going back to the drawing board and strengthening these core strategic elements, the team can ultimately build a more robust, financially attractive, and defensible strategy. The financial analysis ultimately helps stakeholders understand the resource requirements and long-term viability of the strategy, fostering strategic alignment and facilitating executive approval. Here's a step-by-step guide to building a financial analysis to evaluate a strategy effectively. 1. Define scope and deliverables for the strategy. In this step, the planning team identifies all of the deliverables required during the execution of the strategy. This includes both tangible, prototypes, units produced, units sold, and intangible deliverables, intellectual property, meetings, reviews. Break down the strategy. Divide the overall strategy into smaller, manageable project phases with clear milestones. Identify deliverables. For each phase, define specific, measurable deliverables, tangible or intangible outputs, that mark its completion. Set boundaries. Outline what's included and excluded in the plan to avoid scope creep, uncontrolled project expansion. 2. Develop a detailed timeline. Identify all of the required activities to deliver the scope previously identified, when they should be executed and in which order. Sequence activities. Create a chronological list of all the activities needed to implement the strategy. Estimate durations. For each activity, estimate its duration based on resources, complexity, and dependencies. Use a scheduling tool. Consider using project management tools, e.g., Gantt charts, to visualize the timeline and identify potential bottlenecks. 3. Estimate resources needs. This step involves determining the human resources, equipment, technology, and other materials required to execute each phase of your strategy. It should also include resources and effort necessary to develop new, or enhance existing capabilities that foster the company's competitive advantage. Review strategy scope. Refer back to the previously defined scope and deliverables of the strategy. What activities are needed to achieve each one? Identify resource needs. For each activity, pinpoint the specific resources needed and respective quantities. This might include personnel skills, software licenses, specific equipment, or materials. Consider existing resources. Inventory existing resources within the company. Can existing personnel be upskilled or can current equipment be leveraged before acquiring new resources? Identify gaps. After considering existing resources, identify any gaps in personnel skills, equipment, or technology required for successful implementation. 4. Cost estimation. Once the planning team has identified resource needs, they can estimate the associated operating costs, which will inform the overall strategy budget. Here's how to approach it. Categorize costs. Classify costs into two main categories: startup costs and ongoing costs. Startup costs. One-time expenses to be incurred at the beginning of the strategy implementation, e.g., professional services, purchasing software licenses, training costs. Ongoing costs. Recurring expenses associated with running the strategy over time, e.g., salaries for new personnel, software subscriptions, production and maintenance costs. Research and quote gathering. For each resource gap identified, research the associated costs. Gather quotes from vendors for equipment, software, or external services. Utilize internal data. Leverage internal data sources like historical budgets or departmental costs to estimate personnel salaries, operational costs or other relevant expenses. Industry benchmarks. Research industry reports or publications to find average costs related to personnel, technology, or services needed for your strategy implementation. Use spreadsheets. Utilize a spreadsheet software to create a table outlining each cost category and its estimated amount. Consider inflation. Factor in potential inflation to account for rising costs over the projected time frame. Include buffer. Add a contingency buffer, e.g., 10–15%, to the cost estimates to account for unforeseen circumstances. Document assumptions. Clearly document the assumptions made in the cost estimations for transparency and future reference. 5. Calculate cost savings. If the proposed strategy provides any cost savings benefit to the company, it is important to properly estimate them and incorporate them into the total strategy cost estimates and budget. Identify areas. Pinpoint potential areas where the strategy might lead to cost reductions, such as improved efficiency, reduced waste, or better resource utilization. Quantify savings. Estimate the quantifiable amount of cost savings associated with each identified area. Track savings. Develop a plan to track and monitor actual cost savings achieved after implementing the strategy. 6. Cost allocation. To have a better perspective of costs incurred along time, cash exposure, and a more detailed budget description, it is important to estimate cost along time, allocated to the different activities. There are three main approaches to allocate costs: top-down, bottom-up, and S-curve. Top-down cost allocation starts with a total project budget and allocates portions of that budget to different activities based on historical data or industry benchmarks. It is simpler and quicker to implement, especially for complex projects with many activities, and provides a high-level overview of cost distribution. Bottom-up cost allocation estimates the cost of each individual activity based on its specific resource requirements, and then sums them up to arrive at a total project budget. It enables more accurate cost estimates at the activity level and provides better control over individual activity costs. S-curve method. This method visually represents the cumulative cost of a project over time, with a slow initial rise, a steeper increase during peak activity, and a gradual decline towards completion. It is suitable for projects with a predictable cost distribution pattern, with higher costs incurred during the middle stages of implementation. 7. Costs breakdown. For better cost control, reporting and easier evaluation, it is advisable to categorize operating costs involved in the strategy execution into fixed and variable costs. Fixed costs remain constant regardless of output, and are incurred to maintain the basic operational capacity of the business. They include rent, salaries of administrative staff, property taxes, annual software licenses, insurance premiums, depreciation of equipment, some marketing expenses, e.g., website maintenance. Variable costs are expenses that change in proportion to the volume of goods or services that a business produces. They increase when production or sales increase, and decrease when production or sales decrease. Examples of variable costs are raw materials, piece rate labor, production supplies, commissions, delivery costs, packaging supplies, marketing campaigns. Overhead costs are indirect expenses associated with the overall operation of a business, not directly attributable to a specific product or service. Examples of overhead costs include utilities, office supplies, accounting fees, human resources costs, IT maintenance. Some companies may require overhead to be allocated to new projects or strategies during evaluation phase, others may not. The planning team must check with the finance department which are the company policies and rules for overhead allocation. 8. Project revenue growth. Estimate the expected incremental revenues to be generated from the strategy execution along time, considering implementation timelines previously defined. Market research. Analyze market trends, competitor strategies, and customer needs to estimate the potential impact on sales. Forecasting methods. Use forecasting techniques like historical data analysis, competitor analysis, or market research predictions to estimate future revenue growth. Consider proposed pricing strategies and include any discounts or special promotions as part of revenues estimates. Be conservative. It's better to underestimate revenue growth initially to avoid unrealistic expectations. 9. Create pro forma financial statements such as income statements and cash flow projections to illustrate the financial impact over a specific time frame. Provide concise explanations of your financial assumptions and calculations for easy understanding. 10. Evaluate the financial impact of your strategy. When evaluating your proposed strategy's financial viability based on forecasts, there are several key financial indicators to consider. Net present value, NPV. This metric reflects the present value of all future cash inflows minus the initial investment. A positive NPV suggests the strategy creates value. Internal rate of return, IRR. This is the discount rate at which the NPV equals 0. An IRR higher than the company's minimum acceptable rate of return, MAR, indicates a financially viable strategy. Payback period. The time it takes for the cumulative cash inflows from the strategy to recover the initial investment. A shorter payback period suggests faster financial returns. Revenue growth. The projected increase in revenue over time as a result of the strategy. Analyze both total revenue and revenue growth rate. Market share. The projected impact on your market share compared to competitors. Cost savings. The projected reduction in costs due to the strategy, leading to improved profitability. Return on investment, ROI. This metric divides the net profit by the total investment, expressing the percentage return on the invested capital. Total investment is considered to be sum of all the costs associated with implementing the strategy. Break-even point. The point where total revenue equals total costs. A lower break-even point indicates the strategy becomes profitable faster. Cash flow. Project the cash flow associated with the strategy, ensuring sufficient cash is available to support ongoing operations and debt service. Sensitivity analysis. Perform sensitivity analysis to assess how changes in key assumptions, e.g., sales growth rates, costs, might impact the financial viability of the strategy. By analyzing these key financial indicators together, you can gain a comprehensive picture of your proposed strategy's financial viability. This will help you make informed decisions about whether to move forward with the strategy, if any adjustments are necessary, and how to best allocate resources for successful implementation. Additional tips. Involve finance department. Collaborate with the finance department to ensure the accuracy and alignment of your financial projections with accounting practices. Highlight assumptions. Clearly state the assumptions made in your calculations and be prepared to address potential questions about their validity. By following these steps and presenting a clear financial picture, the planning team can create a compelling case for the strategy, increasing its persuasiveness and gaining stakeholder support for the proposed strategy. And this concludes our episode about evaluating the financial viability of a strategy. Please be sure to check our next episodes where we discuss scenario and sensitivity analysis for the strategy being evaluated. Until then, keep strategizing. See you soon.